The Hindu Zone is a career guidance platform that suggests the best coaching, colleges, courses, while acknowledging factors like fee, location, language, and faculties. It provides test series and study material. Also, it organizes mentorship programs with industry heads to guide and inspire the students. If you are also looking for career guidance, contact thehinduzone.com.
Hello everyone, good evening. Abhi.
So please go ahead.
Yeah, okay. Hello everyone, good evening and welcome to a new edition of the Indian Express Explained Live, our series of online explanatory conversations with domain experts and authorities on specific subjects. I am Monojit Majumdar, editor for explanatory journalism at the Indian Express. Today, we are discussing inflation and interest rate hikes. It's something that impacts not just the Indian economy as a whole, but each one of us at a personal level, as all of us know. There are many questions, of course, where we are, how we got here, and what lies ahead. And to answer some of these, we are delighted to welcome tonight Neelkanth Mishra, India strategist and analyst with Credit Suisse, who is also part-time member of the Prime Minister's Economic Advisory Council. Neelkanth, thank you for your time. We're very grateful to you. Speaking to Neelkanth Mishra will be my colleague, National Business Editor Anil Shashi. Today's Explained event is brought to you by our associate partner, thehinduzone.com. My thanks to our partner, and thank you all for joining and welcome once again. Thank you for your time. Anil, we're very grateful to you.
Thank you, Manojit.
Speaking to Neelkanth Mishra,
a discussion on inflation could not have been more timely, and we can't have a better person than Neelkanth Mishra for this. Given the context, I can't help but
and thank you all for
go back to an interesting comment by German economist and former Bundesbank President Dr. Karl Otto Pohl, who'd drawn an analogy between inflation and two things, and saying once it is out, person you can hardly get it back in again. So the best given the context, I can't not squeeze too hard on the tube. I'm sure, given the current scenario, a number of central bankers would perhaps be in agreement with what he said in the 1980s. So Neelkanth, just to get the discussion underway, how entrenched is inflation during this current phase? And in what ways is this inflationary episode perhaps different from the earlier instances of runaway global inflation that we've seen, the most recent one being the 2010-2012 post-global meltdown inflationary run that we saw? So how do you see this in the vis-a-vis the overall sort of scenario?
Well, thank you, Anil. Thank you, Manojit, for inviting me for this session. When we are thinking of inflation, the primary reason inflation occurs is that demand overshoots supply, right? So price is a signal which is important, partly to destroy demand. So if prices become too high, people consume less, and high prices also trigger new supply. So high prices generally mean that demand is far higher than what supply can meet. So there is a global perspective here and there is a local perspective here. When we are thinking of the global perspective, we have to think about it pre-Feb 2022, when the Russia-Ukraine conflict started, and post that what has happened. So during COVID, so before COVID, demand and supply globally were more or less matched. Generally in an economy, that's what happens. During COVID, because of the lockdowns, both went down, right? So certain types of supply were constrained because of lockdowns, certain types of demand was constrained because of lockdowns. Then governments gave a demand stimulus, right? So and then in the US in particular, there was excessive stimulus, and now I think it's consensus that they stimulated too much. And supply, because of COVID and because of some other factors, took a while to ramp up. So you must, I don't know if you observed, supply has been improving if you exclude the Chinese lockdowns in the last 2 months, very steadily in the last 4-5 months, right? So as the economies have opened up, supply is responding, but demand had gone up well in advance. That created inflation. That inflation was exacerbated by what we call supply chain bullwhips. So what happens when there is a slight amount of shortage is that everyone moves from just in time to just in case, instead of having exactly enough inventory, you start saying, I don't want to lose production, so let me order some more. And what that means is that apparent demand starts to move up much faster than real demand. So if you're a producer, everyone in the channel is building inventory. So what you're seeing, this is why it's called a bullwhip, right? Like in a bullwhip, you move your hand this way, the end moves at 300 kilometers an hour. In the US, in particular, this became really bad because they didn't have the manufacturing capacity to meet the additional demand, but they had triggered that demand by handing over cash to people. And the ports which had to handle the influx, so therefore the demand went over to China, Japan, India, Vietnam, Bangladesh. As the goods started hitting the US ports, they realized that the ports didn't have the capacity, and the inland evacuation also was actually struggling. So they just couldn't meet the demand, and therefore inflation went up because there were shortages, supply, and the ships weren't arriving on time, the containers weren't arriving on time. There was massive shortage. That was one part of inflation. What that has done is it has also triggered in the US a wage price spiral, which is the most dangerous form of inflation, which is the toothpaste analogy that you gave, that because everyone is now used to 5, 7, 10% inflation, they start demanding those wage hikes, and then everything has to be priced up. That has to be broken. Post February 2022, what has happened is that global supply has actually gone down. So there is bound to be inflation. So in this way, there are parallels that you can draw to what happened in the 1970s when a similar oil reduction had happened. The volume of, and energy, dense energy is critical for economic growth. So if there is a physical shortage of gas, if there is a physical shortage of oil, global GDP has to shrink by that much. Now, for that to happen, demand has to fall, and for demand to fall, prices have to go up. So I think this is a very serious problem. The fiscal and monetary interventions which can be done. So right now, for example, most countries which can afford to are subsidizing oil prices. So everyone from Australia to the US to China to Japan is giving incentives. They have cut down excise duties so that the retail price of oil doesn't change. The suppliers who are benefiting from this are unwilling to invest in new capacity because they're unsure how long this lasts. And there is a third perspective here, which is what I would call forced saving. If the global oil market was $2.5 trillion, it was around that number at $70 a barrel, it is now closer to $4 trillion, which means that there's an additional annual $1.5 trillion, which is moving from consumers to suppliers. So the consumers are consuming less, and the suppliers who are getting all that surplus are saving it because they don't want to invest. So this is a forced saving for the world, and which is also, I think, very bad for growth, which is why you keep hearing this word stagflation. I think the first wave of that inflation, which we discussed because of the US giving excessive stimulus, is now starting to fade. You would be surprised to know that the US federal fiscal situation in the month of April was a massive surplus. That is, their deficits, excessive record deficits, because they're also seeing a record high in taxes, and their incremental stimulus is fading. Plus, US demand has started to fade. The supply response is coming through. And now the reverse side of the supply chain bullwhip is showing through, right? So we are seeing semiconductor orders falling out. PC and handset suppliers are sharply cutting orders because they're realizing that demand is weak and they have too much inventory. So the first phase of the inflation is now starting to correct. So copper, for example, is down year on year. Aluminium had peaked at 4,000. It's now at 2,800. The second phase, the February onward inflation on food and energy, is something that will take, I think, 12, 18 months to settle. So this is something that I don't think is going away in a hurry.
Right. Just panning back to the India situation now, the WPI surging to a record high and staying in double digits for 13 months in a row. The CPI is also at a 8-year high of close to 7.8%. From a policymaker's perspective, is there a concern that the CPI based annual inflation, which is the retail inflation, converging towards the WPI-based wholesale inflation, which is perhaps in deviation with what is the usual trend, that is the WPI collapsing towards the retail inflation line?
So clearly, those are very serious concerns, and policymakers need to think through them. Whether rate hikes are the right solution is something that is debatable. So let's start with the increase in year-on-year inflation. See, we tend to look at inflation on a year-on-year basis. That is how our policy tools are geared. That's how our narratives are structured. But what is helpful is to look at how inflation impulses have been coming through, right? So you look at month-on-month changes, which are below or above seasonal. So in general, for example, from April to May, prices go up, right? The CPI index will move up, but because it happens every year, the year-on-year number won't change much. If we are seeing CPI inflation go up from 4.3% in September last year to 7.8%, as you rightly said, for April, it has come through because of much above seasonal moves in the CPI, the index itself, month-on-month moves in October, November, in March, and in April, right? So the October-November moves were almost 100% in vegetables, right? So vegetable prices went up very sharply. So while onions, I think, were starting to correct, I think tomatoes, potatoes, I think there was some inflation. The inflation in March and April is to a large extent global, right? So crude oil had to go up, and it went up, and therefore petrol and diesel prices went up, edible oil went up, processed food went up because that uses a lot of energy and edible oil, imported edible oil. Now, so the first impulse, which was primarily domestic, October to December, the second impulse was to a large extent global. If you drill down into why the first impulse actually came about and see if there are trends which make them sticky. So for example, if you look at vegetable prices, over the last 10 years, since 2012 to 22, onions, tomatoes, and potatoes have been very volatile, but the broad range has actually not changed too much. And the reason for that is that most of the costs are domestic in the sense that automation being still limited in our agriculture, most of the costs are rents, that is land rent, finance costs, human labor costs, seed costs, and fertilizer is something that, again, the government has totally subsidized. So the cost curve in vegetables has not moved up, and therefore the stickiness of that inflation is, I think, quite limited. What has also happened in April is that cereals inflation went up mostly because of wheat, and given what has happened to global wheat, it is natural to think that this happened because of global wheat, but I think the drivers were slightly different. Because of the free grain scheme, right, the Pradhan Mantri Garib Kalyan Anna Yojana, there was an excess of grain supplied into the market, and because of that, last year rice and wheat prices had been falling, and therefore on that low base, and that base I think corrects from about 2-3 months later. So there are several one-offs in that local component, which I think make it somewhat unnecessary to slow down the inflation by slowing down the economy. When you raise rates, you are partly signaling to the economy that you should, that I'm going to slow the economy down, so you please increase or reduce your inflation expectations. But it's also to actually slow down the economy so that the demand supply starts to match. When it comes to global inflation, we need to think about how the future inflationary impulses will play out, right? So we've kind of priced in $105 oil. If oil goes to 120, so suppose when China totally opens up, if say Russian supply was to fall further, oil can go up further from here, and then we could see another inflationary impulse, which is why I think it is reasonable to assume that inflation, the headline inflation, will remain high and volatile for a while, for several months. Whether that requires our economy to slow down through rate hikes is something that I think is debatable.
Right. So two things again on the timeline that you'd sketched earlier, broken by the pandemic in between, in terms of how the inflation trajectory globally has moved. In most of the developed economies, growth had sort of probably reached the optimal levels before the tightening started. In emerging market economies, especially India, clearly growth hadn't picked up. It was nowhere near the optimal level. But for a number of effects, including the spillover effect, we are now beginning to tighten, and send this signal that we need to slow it down. There's criticism of when the central bank has intervened, and I'll come to that later. But is there a developed economy versus emerging market economy, a variance in terms of how the interventions by the central bank, the timing of it, and the fact that these are happening at different stages of the growth trajectory? Would that have a bearing on how the tightening cycle now pans out?
That's a great question, but I don't think there is a straightforward answer, because I think the biggest problem for India right now is our significant dependence on imported energy, right? So imported energy is 4% of our GDP. So if prices go up by 50-60%, you see a natural outflow of nearly 2.5%, 2 to 2.5% of GDP. And I think it's very simplistic, and you shouldn't really be doing it. But as a ballpark, if you think that this is so everything else is the same, suddenly prices have gone up by 2.5%, right? And is it necessary really to raise rates to control that price, especially if you assume that if oil went from 70 to 100 and that is 110, and that is why prices have gone up so much. If the impulse was to be the same, should we expect prices to be at $160 next year, right? Because for the impulse to be the same, they'll have to go up by the same amount next year. So our challenge is that we need to curtail demand, and our biggest problem is our balance of payments. Because this is all imported, we were running a reasonably comfortable balance of payment surplus, about $15-20 billion on an annual level. If your imported energy bill goes up by $90 billion, so at $120 oil and commensurate increases in coal, in gas, in fertilizer, and edible oil, because all of them at some level are linked, your balance of payments is suddenly in a $70 billion deficit, right? So for your audience, perhaps perhaps maybe easier to explain it thus. If you have a household which consumes more than it earns, right? Which is, so if the country is a household, we consume more than we earn, right? Which is why we had run a current account deficit. So we are, say, for argument's sake, consuming 110 and producing 100. So $10 have to come from outside. And for that, we need to sell our assets or borrow, right? So that's the capital flow that we keep getting. If, because our imported prices or the prices of some imports have gone up, that 110 becomes 115 or 120, it is very hard to find an extra $5 or $10, right? And so therefore, we need to reduce our consumption. The question to ask is, and this is inevitable. There's nothing that you can blame RBI for, that energy prices have gone up, right? So this is a very necessary adjustment that needs to happen. Now, you can keep paying for it by increasing capital flows, but in this market, that's not going to happen. So you need to reduce your imports. Now, should you reduce your imports by raising rates and slowing down the overall economy, or should you reduce rates, or should you reduce imports by just weakening the currency and therefore making only the imported prices even higher? So the headline inflation goes up even more, but that may actually be a much better mechanism for addressing the balance of payments problem. So that is, in my view, the crux of our challenge. If this had not happened, I think using the metric that you use, and I think that's a very important metric, we would have actually reached much closer to our pre-pandemic path than most people believed. Right. So if you had asked me in January and February and before the war, my view was that we would report GDP growth 3 to 4% points higher than what was expected in FY23. That number now has to be brought down because there's almost a 2.5–3% of GDP extra burden of energy costs. That's the prism through which I would see this adjustment that is happening, not necessarily as are we late in the cycle, are we early in the cycle. I think we need to frame monetary policy based on our needs, not how the Fed is doing it.
Right. So the RBI's role here, in stepping in, like the other central banks. So there's this debate on, and that's something that you've touched upon, how much can rate hikes achieve, what can they achieve in a scenario where perhaps 3/4 of the inflation, has a global element to it. A lot of it is food and fuel, and when you look at core, even with the latest WPI numbers, it's still around 11%. Core inflation is the non-fuel, non-food inflation. So in terms of tackling inflation, there is that one argument. On the other side, the argument is the RBI is perhaps accorded primacy to its role as the government's banker, than its role as the economy's monetary authority. So that's purely based on the assumption that they did not act for so long, and then there was this off-cycle, action that happened. One of the MPC members has also sort of come out and said that we need to sort of front load much of the hikes, and how do you see that the RBI's role?
So let's view this through two different prisms, right? The first is that the economy is now normalizing, right? And while there is we can keep debating endlessly on what is the right employment indicator, but in my view, the most reliable and high frequency one is Narega job demand. So if Narega job demand is very high, means unemployment. If someone is willing to work in this heat for 200 rupees a day, they clearly are desperate, right? Which means that there is a big problem. And if there are 2 crore people wanting to do that, I'm sure there are 5 crore people wanting to work at 500 rupees a day. So that's a very important indicator of the slack in the economy. And at the bottom of the economic cycle, or rather during the COVID lockdowns, that number had gone up by almost 2 crore. That number is now only about 20 lakh higher. So April in 2021, the average during the month was about 20 lakh higher than the average in April 2019, which I think is a very important indicator of normalization. So if the economy has started to normalize, if power demand is growing so much faster, of course, it's driven by heat, but I think it is also a sign, so trains have started, schools have restarted. I think there was a necessity, I would say, even 3, 4, 6 months back, for the accommodation to be removed, because the economy, once the restrictions were being eased, and there was some evidence that the scarring was perhaps not as bad, it should have been done. But there's a second aspect to it, which is that which tool do you use? So as you know, there is a repo rate, which is the rate at which banks borrow from the Reserve Bank. And there is a reverse repo rate, so that if banks have surplus funds, then they deposit. So when there is significant overnight liquidity, so there is too much money in the system, banks are unable to lend it. So overnight, they deposit those funds with the central bank. So when you have this kind of surplus, the effective rate is the reverse repo rate. It is not the repo rate, right? Because if the banks don't need to borrow overnight, the impact on effective rates is actually a lot smaller. There are bank rates which are linked to the repo rate and all that, so there is some impact, but the effective rate is the reverse repo rate, and that has gone up. So from September 2021, where for the fortnight ending September 2021, the cost of absorption, the reverse repo, effective reverse repo rate was 3.37%, to February, where it became 3.87%, because the Reserve Bank started to absorb a lot of the liquidity through what they call the VRRR, right? Variable rate reverse repo auctions. And then they cemented that in the previous cycle by sort of undoing, keeping the reverse repo where it is, and then introducing a new rate on which they would absorb all the surplus liquidity. So there has been some tightening, right? I think the continuation of accommodation is something that perhaps could have been removed earlier, given that the economy was showing signs that it was starting to normalize. But remember that there is still that slack. There are still 20 lakh extra people asking for NREGA work. And we are still, as you said, below what our pre-pandemic trajectory was. So, we are far away from overheating, right? So the wage price spiral that we are seeing in the US is not visible in India. I mean, this is why I highlighted the fact that most of the costs in vegetables are local. And till the time that we see local wage rates start to go up significantly, there is less of a necessity to tighten because of the risk of entrenched inflation expectations. This is something that need to be watched, right? One of the MPC members in the minutes has said clearly, and I think this is a very fair risk to be watchful on, which is that we do not want inflation expectations to get entrenched. Meaning that if you see headline inflation, and there I don't think WPI is the right benchmark. I know it is higher and it makes for very good headlines, but I think the inflation expectations are more anchored to CPI. WPI is what companies see. And it's much more influenced by crude and commodities. And if you see, if aluminum is falling, steel is perhaps likely to fall, then I think it is less important. So if inflation expectations start getting entrenched, then I think we need to be a lot more worried. If it is a 6-9 month problem, it is a reset higher. If it's a reset because the USD INR is going from 77 to 80, it is not necessarily something that I would warrant a very substantial increase in repo rates. But given that the economy is healing and is normalizing, I think some normalization of the repo rate, some removal of the accommodation was necessary and is starting to happen now.
There's also this general expectation that as inflation goes up post-pandemic, that is, a lot of it is perhaps because consumer spending is focused on goods and services, because of the lockdowns and restrictions. People are not able to spend, and obviously, unlike goods, you cannot stock services up. So this diversion away from goods, once the economy sort of opens up almost completely, as it's happening, do you see that having an impact as services come more and more into play, especially in a consumption economy like India? And in the US, a couple of days ago, you had big retailers like Target and Walmart reporting excess inventory. Is it a sign that in the US, this shift is perhaps already happening, and is that a precursor to what we could see in India?
Absolutely, and that is what I was talking about earlier when I talked about the supply chain bullwhip, that everyone moved from just in time to just in case when they are stocking up. And so now, there was a period where they wanted to buy more than they needed because they just were desperate for supplies. Now they're realizing they're sitting on too much inventory, and demand is actually coming off, because as you rightly observed, when you're sitting at home, your demand tends to shift from services to goods. So instead of eating out in a restaurant or traveling to the nearest national park, and I'm using a US consumer's analogy here, you end up renovating your TV or buying a new one, doing up your gym. And how many times will you do your gym? I mean, anyway, you don't go there. At least I don't. So the thing is, when the economies open up, the reversal of this happens. So which is why US consumption is actually holding up. Goods consumption is falling off, right? So year-on-year trends in goods are quite weak. I see less of a risk of that in India because I think one, in the global goods demand, India is almost irrelevant. So, but that is a factor, which is why I think that goods inflation is in the US is transmissible because goods are generally much better traded. So if goods inflation is higher in the US, it will show up as high inflation in India, in China, in Japan, and everywhere else. Services inflation is a lot less transmissible. So if the remaining inflation in the US is only in services, their taxis are becoming more expensive, or eating out at some burger joint is more expensive, it is not necessarily something that will hurt us directly. And which is why on one part of that global inflation, incrementally going forward, I would be less worried. The only thing I worry about is this sudden shortage of energy and food at a global level, which in its own ways, I think will show up in our economy as well. And particularly as because of energy. Because as we keep growing, our demand, you cannot grow GDP without using dense forms of energy. And as we keep needing more and more of that, and there is no supply response, I think there is a big problem.
Right. So as the RBI begins to hike, what are the signals that are perhaps the most important? You've touched upon a few of these earlier, but is it in sort of tempering the inflationary expectation? Is it in to try and curb credit growth, which anyway is not really picked up? Or is it the impact on the currency front that you mentioned, that higher rates perhaps would lure more capital in, lead to an appreciation of the currency vis-a-vis the others, but that might not be that much of a factor now because the Fed is also hiking. Which of these areas are
so I think the third of these is perhaps and here I'm being prescriptive, right? So I mean, in the markets we are trained to be predictive. I mean, what I think should happen is not very important. It is much more important to expect what is likely to happen, right? Because that's when you make money. I think the mid-cycle, the off-cycle hike was to a large extent influenced by the Fed's hiking, right? Because when we think about capital flows, we tend to think about capital flows as portfolio investors, as foreign direct investment, as venture capital, as private equity, as external commercial borrowing. A very reasonable part of our dollar inflows is actually trade financing. So what happens is that if the Fed hikes and you don't, overnight, and these are all very short-term loans, right? 3 month, 6 month loans. It makes much more sense, even if on a currency arbitrage basis, because the US rates are always lower than Indian rates. It's just that there is a risk of the rupee depreciating, so which is why those rates are stabilizing at a certain gap. Now, if that gap widens, it makes sense for the new borrower to repay the dollar debt and borrow in rupees, right? And what that does is it increases the demand for dollars. And so while what you were saying was that if you raise rates, you get more dollar inflows. That is not really true in India. If you see our capital inflows, most of our capital inflows are related to growth, right? So it's foreign direct investment, venture capital, private equity, portfolio investment in equities. We don't have rate-linked flows. I think the hike needs to be, and perhaps was, defensive. Because if you remember 2013, that is where a reasonable part of the attack came from, or rather when the rupee came under attack, it was to a large extent trade financing, which started to get unwound, right? And then suddenly you needed $20 billion more. Everyone blamed the FPI debt, the foreign portfolio debt flows. The other aspects of the two other aspects that you mentioned, so there is inflation expectations and reduction in demand. I don't think the RBI would really want when they hike rates, they want to slow down credit growth. I think the objective is to increase savings, that people consume less, right? So that's the primary thing. I think credit growth is more demand driven, so I don't think they try to influence that directly. There is some element of that, but at 30-40 basis point, maybe 100 basis point, I don't think really changes behavior that much. But inflation expectations is something that is, I think, serves a signaling. I mean, there is a signaling tool. Much more senior economists than me and much better trained economists than me have said that people pretend they understand how inflation expectations are set, but I don't think anyone, so I don't know if RBI is, maybe it does, maybe it doesn't, but that's the convention. So perhaps it's okay to follow convention once for a while. But in any case, there was some normalization that was necessary given that the economy is reviving. So some rate hikes will happen, should happen. But I think what we need to look out for is if the Fed keeps hiking on the very short-term flows, if we are not careful, we could see a much sharper dollar outflow than we have seen so far, and which can actually then pressure the currency. Remember that in Japan, which has a much better international investment position than the US, it also has much lower inflation than the US, but it is the yen that has fallen against the dollar. And it is mostly because of money market fund flows, which is very short-term rate arbitrage, right? So those are things that as a policymaker on a tactical basis, you need to be very careful about. So I think it's a very defensive hike. And I think that future hikes may be necessary, but they were anyway necessary because of the normalization of the economy.
So we have some questions from the audience. So we'll try, and we've got 20 minutes for that. So we'll try and take these one by one. The first question is from Miss Nancy Jangra. She's an educational counselor. Ma'am, please go ahead. You have to unmute yourself.
Hello. Yes. Sir, it's nice to be part of this webinar. I am audible?
Yes, you are. Yes.
Okay. Okay. Thank you for this opportunity, sir. Sir, I have a question that inflation is rising. So, will it dent India's economic recovery? Will it?
Yeah, so yeah, now you're on mute again, but yeah, I think that instead of just looking at inflation as denting our economic recovery, though sustained inflation above 5-6% is something that does destabilize economies and therefore our reason for targeting 4% inflation. So of course current debate would be whether inflation would become sticky at 5-6% or higher. But as of now, the risk and the challenge for us is that we are dependent on imported energy. You cannot grow without dense forms of energy, and that has become expensive. And that I would, at least for now, consider it as a step jump that supplies globally have constrained and are constrained, and therefore prices have gone up. Will prices keep going up even if there was a global recession, which now seems the likelihood is rising, is the question. But I don't think by itself this spurt in inflation is going to slow us down. The underlying drivers of growth are actually quite robust.
Next up is Mr. Anand Vijay Jha. He's from the Blackstone Group. Mr. Jha.
Yeah, thank you.
Hi, Anand.
So, one question which I had, of course, a little tangent. Will we see the relaxation of FDI in banking further above 10%? Because a lot of banks do require transformation. And I wanted to understand whether you think that the government has a certain degree of openness in this direction.
One of the challenges which had been highlighted or which had been discussed and considered in the last 3-4 years was as the PSU banks were seen as unwilling to grow their credit substantially, that if the economy had to maintain, say, a 12-13% nominal GDP growth, will India's credit or financial system be able to manage that level of growth? And which is the reason why even the privatization of PSU banks came to be considered quite seriously. This is a proposal that has been made several times, but 2 years back, the government did bring it back and mention it in the budget. So the expansion of financial system capacity is something which is very, very much on the radar. And the fact that the government is willing to privatize PSU banks is a sign that they're allowing. And there have been private banks which have been allowed to take over, and global multinational banks which have been allowed to take over. Like one failed private bank was taken over by a multinational bank. So I don't think, in principle, there is any constraint on permitting that. The rest would be, as and when necessary.
Mr. Manish Agarwal from the Institution of Engineers, India. Mr. Agarwal.
Hi, can you hear me?
Yes, we can hear you now.
Okay, thanks for this very enlightening and informative discussion. So actually, I wanted to ask Neelkanth this question. Okay, my question is as follows. Like inflation is hurting everyone in India, particularly the salaried class and the poor. Many people have lost jobs during the last 2 years of COVID pandemic and are still unemployed. Rise in petroleum prices, petrol, diesel, LPG has had a cascading effect. Continued Russia-Ukraine war, fall of rupee to lowest level against the dollar has all exacerbated this crisis in India. Unemployment is high, prices are rising, and people are suffering. Loans are getting dearer due to policy intervention by the RBI. So all in all, the situation in India is really grave for the common man. Now, so my question is how to tackle this situation, or how can the common man deal with the inflation to make the two ends meet? Thank you.
Okay, so let's think about inflation as a source of pain, right? So what is inflation? So inflation is a combination of prices, right? So the consumer price index has goods, has services. I mean, so all the things that you and I consume are part of the consumer price. So let's think about, and then we take weighted average changes, and that's what inflation is. So long as the demand and the supply are both domestic, what is good for some is bad for the other, right? So if prices go up a lot, so if say onion prices, which are currently very weak because of oversupply, if onion prices go up to say 80-100 rupees a kilo, which they had gone 1.5 years back, the average consumer is suffering, but whichever is the farmer or the intermediary is actually benefiting, right? So there is someone who is benefiting and someone who's losing. So at an aggregate level, it is a neutral, right? There are longer term implications. As I said, if inflation is sticky and high for a very long time, there are growth implications of that, which are which of course policymakers need to think about. But at a pure high inflation level, I think what is beneficial for someone is hurting someone else. When it comes to imported goods, which is why the energy price change is very important, is that the $90 billion extra, right? So our energy imports every year, or FY22, the year that just ended, was $150 billion. If oil stays at 120, that goes up by about $92-93 billion. Now, that is a $90 billion outflow to someone outside the country, and that is a drag on growth. That clearly is a problem, and we need to learn to adjust to it, because I don't think energy prices are falling in a hurry. And this is something that I think is going to be very hard to control. Over a medium term, we need to become more self-sufficient in energy. We need to increase our electrification and a lot of other things. But I don't think there is any other solution. As regards growth, while clearly India is a very large and diverse economy, there will be parts of the economy which will struggle, but there are parts of the economy which are actually doing very well. If you see our services exports, net services exports in March and in April, they have hit record highs. So the annualized number in April of net services exports was $144 billion. The monthly number was about $12 billion. And this was because there are large segments of the economy which are doing very well. Our goods exports have also been doing well: electronics, specialty chemicals, apparel, and in these segments, clearly there is there is job creation, there is new investment. The dwelling construction market is reviving. So the state governments are starting to spend. So the last 2 years, state governments had been unable to spend because they just weren't used to working from home. So there are many drivers of growth which should keep us optimistic on the underlying trends in the economy. It is just this extra 50 to 70 billion, depending on what oil price you take, 50 to 90 billion dollar extra burden that has been imposed on the economy because of the Russia-Ukraine conflict and the sanctions that followed, that we need to sort of wade through. And I think that will happen in the next 6 months. Half of that has been done. Half of that has already happened. I think oil prices may go up further from here. That may be another, maybe 3-6 months of adjustment. Once that is done, and I think we should be a lot more optimistic about the Indian economy.
If I can slip in a follow-up question, the rupee's depreciation that is underway. There is a sense that the upside for us on the export side might not be that much, but the downside in terms of the imports would be much more sort of, there'll be much more impact, given that there's already oil, now coal is added to the mix, and these are all things that we cannot really do without now at this point in time.
Yes.
So, yeah, does that also worry you in terms of how the exchange rate sort of plays out?
But I agree with you. There is absolutely no disagreement with what you said. But if there was a question in there, I think I think the implicit question was, should you then let the rupee depreciate, right? So, but that is part of the adjustment process, right? That see, it is going back to that household example. Now you can't afford it. Right, so you are running a $70 billion balance of payment deficit. There is no way you can afford it. Suddenly the energy that you imported has become more expensive. What do you do, right? So you need to, and if you let only oil prices go up, only fertilizer prices go up, or only imported coal and therefore power prices go up, the economy will suffer even more. So letting the rupee fall and then spreading that pain over all imported products, right? Unless imported avocados become more expensive, people will not shift to domestic avocados, right? Or imported blueberries, or I know those numbers are very small, but this is just an example. So if you spread the burden over all imports, it is the least bad option, right? So there is no good option, because the reality is that you needed something and that has become more expensive, right? And so if you're absolutely right that inflation will go up if the rupee falls, but that is part of the process. People will not stop having imported avocados till the time that those become more expensive.
Okay, we have a question from Mr. Suresh Sharma. He's with the ICFAI Business School. So please go ahead.
Yeah, thank you very much. I am very happy to be a part of this discussion. I have heard Professor Mishra very carefully. Professor Saab, I tell you, sir, even if you are not a professor for a while, doesn't matter. You are a professor for us at the moment. I tell you, there is a great effort not to reveal the truth, you see, unfortunately. The fact of the matter is that Reserve Bank of India is mandated to manage inflation in the Indian economy. They are expected to maintain it around 4% plus minus 2%. Inflation in the last several months, has been hovering around 6%. All early warning systems have been ignored. Even the bond yield, if you see the first quarter of 2022, has been negative on the government bonds, The treasury bills, that means virtually government is borrowing at a negative rate of interest. And the real rate of interest has become negative, which means you are pushing people from the banking sector, from the bank deposits. You want them to enter into mutual funds or into the capital market, etc. So this kind of a whole restructuring is good. It is desirable. It is maturing of the Indian economy. But in the process, what has happened is, sir, that a large number of people, millions and millions of middle class today, is in trouble, you see. Their quality of life has suffered, their standard of living has suffered, they are having social tension, family tension, all kinds of conflicts are there. Look at this cylinder. It used to be 600 rupees a cylinder. Today it has crossed 1100 rupees or around 1100 rupees, you see. I made the payment myself, so I know it, it was more than 1,000. So the point is, sir, inflation anywhere in the world is a monetary phenomenon. Milton Friedman, everybody knows, Nobel laureates have been given prizes after prizes for the last so many decades, So we should at least share the truth as it exists today. The truth is that in the name of stimulating growth and in the name of modernizing the economy, formalizing the economy, we are playing with the savings of the poor people and transferring those resources to the business class in a manner which is not just and fair, sir. So I have given my viewpoint. You kindly give your viewpoint, sir, on this.
Yeah, thank you. So the first thing is this whole objective that that the poor are suffering because of low interest rates is something that I disagree with. I mean, you and I and all of us, partly because the way we grew up. I mean, I grew up when my mother used to buy kerosene from the ration shop, and the kerosene would run out, and she would buy coal from and then use a chulha to cook food for us. We all think of ourselves as middle class. We are not. We are in the top 5-10%. I would be reasonably confident that everyone on this call today is among the more prosperous. So we need to have more trust in the business community for more investments, for more jobs, and that philosophical point of view that we keep having high interest rates and somehow magically jobs will get created for the rest of our countrymen and women is something that I would disagree with. When it comes to the setting of interest rates, the reason I use the pre-February 2002 and post-February 2002 difference is that things have indeed changed after February. Pre-February, the inflationary indicators, I mean, if I summarize some of the stuff I've said earlier, there was a goods inflation side, which was driven by excessive stimulus in the US, which pushed up demand. Supply didn't ramp up in time. There was a problem of port capacity, evacuation capacity in the US. Inflation went up a lot. They ordered even more because they were short of goods, and that created even more inflation. But now that whole thing is collapsing. That whole thing is unwinding. So if nothing else had happened, if the war had not happened, I think the goods inflation that we are seeing the world over would have tapered. The US has given such a large stimulus that they also have a wage price spiral, which is in services, but that is less of importance to us, right? So services inflation in the US has very little correlation with services inflation in other countries. What has happened after February is very unfortunate. It is much more unfortunate for the people who are suffering the war, but even for the world outside, energy costs have gone up. And if you think about people around the table deciding who should get the remaining energy, the only way to decide who will get that energy is to raise prices, because then the weak hand folds, right? the weak hand has to then step away. And for that, prices have to go up. And these are essential goods. See, when onion supply falls by 5-7%, prices go up by 200-300%. The reason that happens is that onions are so essential to our diet, you need to raise prices by that much for that 5-7% reduction in demand. We have to think about energy prices in a similar way. These are very essential to growth. So people are very reluctant to let it fall, the demand to fall, which is why prices have gone up. So the recent surge that you are seeing, which is why the prism I used, that a lot of the inflationary surge till December was vegetables. There is no sticky inflation visible in vegetables. There is something happening on telecom, but that's a normalization of the earlier rate cuts. There is less to worry about on rates. There was some normalization that the RBI could have done, perhaps should have done, but that would not have affected what has happened after February, right? So if energy prices have gone up, we need to live through that increase because we are unfortunately dependent on imported energy. The lesson for us from this should be to increase reliance on domestic energy, right? So if we are expecting to grow at 7% real terms in the next 10, 15, 20 years, we have to build in and plan for growing energy supply by at least 4 to 5% a year, every year. That is the best way to not let this episode recur. But I don't think there's any easy solution right now.
Thanks, Neelkanth. We have a question from Mr. Sandeep Soni. He's with the Punjab National Bank. Mr. Soni. Please unmute yourself. I don't think he's there, but maybe I'll ask a follow-up question to the answer that you gave. The negative real interest rates, that is the nominal interest rates minus inflation, the fact that there was a problem there. Has that been pushing savers into riskier instruments, maybe stocks and crypto? Because I'm saying that retail investors are entering the market at a time when FIIs are selling out, and there's been a bit of a trend that's been sort of continuing. Is that a signal, and does the RBI have a part to play?
Yeah. So again, think about how much gross financial savings we generate in a year, right? So 12-13% used to be the normal of GDP. During the pandemic, it had gone up to 18-20%, but let's assume, say, 13%, 14% is the normal. So 260 trillion is the economic size this year. So 13% of that would be about 340 trillion, right? 260 plus, yeah, so 340 trillion, or 34 trillion, 34 lakh crores. The total inflows into equity markets on a rolling 12-month basis, it tends to be about 2 trillion, 2.5 trillion rupees. So clearly there is some impact of low interest rates, which triggers some people to take those risks. But believe me, I've spent 20 years in equity markets. It is the behavior of the crowds, which is a far stronger influencer of how much money flows into equity markets than interest rates. Just to give you perspective, so there is something called an equity risk premium. So there is something that you can calculate that what is the additional returns people are demanding from equities over and above the risk-free rate, which is the 10-year Government of India bond yield. The equity risk premium on Indian yields in October, November last year was negative. So and in fact, in February, it became even more negative because 10-year bond yields went up even more. So Indian government bonds were considered more dangerous than Indian equities. You cannot explain that through interest rates. It is the mania of the crowds, and I wouldn't blame the RBI for that kind of behavior. But yes, I think interest rates at the margin do influence, and that's only logical to expect that. But again, remember that we're talking about a 30 trillion and 2 trillion ratio here. right? So if 2 goes to 2.5, it's a 25% growth. But in the overall scheme of things, there's not too much of allocation. Crypto is something, again, makes for good headlines. But, I asked one of the runners of some crypto unicorn, how much is exactly owned by Indians? $6 billion, which is a lot of money. But, $6 billion in the overall scheme of things is I don't think something that policymakers should really bother about.
Right. Thank you, Neelkanth. I think we're through with the questions, and thanks for a sweeping, almost professorial discourse
$6 billion
on a subject that is a little
in the overall scheme of things.
It needs a little bit of decluttering. I'll hand it over back to
I don't think something that policymakers should really bother about.
Wrapping up the session. Over to you. Thank you, Neelkanth. I think we're through with the questions, and thanks
yes,
for
of course. Thank you, Neelkanth. That was wonderful. Wide-ranging analysis and explanation. And thank you, Anand, for helping this conversation so wonderfully. All of us, I don't think know, but the rest of you, I hope you agree with me. Thank you to our associate partner, the HinduZone.com. And thank you, each of us. Thank you, Neelkanth. That was wonderful video of wide-ranging analysis and explanation. And thank you, Anand, for expressing this conversation and edited transcript will appear all of us. I don't think know, but the rest of you will agree with me soon. Thank you to our associate partner, the HinduZone.com range of issues. Thank you, each of us. Thank you, databases. That was news, video, opinion. I'm sure you like this discussion. And thank you. Next edition of Express is live and edited transcript will appear all of us. I don't think know, but the rest of you will agree with me soon. Thank you to our associate partner, the HinduZone.com range.
The HinduZone is a career guidance platform that suggests the best coaching, colleges, courses, while acknowledging factors like fee, location, language, and faculties. It provides test series and study material. Also, it organizes mentorship programs with industry heads to guide and inspire the students. If you are also HinduZone career guidance platform that suggests the best coaching, colleges, courses, the HinduZone is a career guidance platform that suggests the best coaching, colleges, courses, provides tests acknowledging factors like fee, location, language, and mentorship programs. It provides tests